Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today, we're going to be talking about how a self-directed investor might efficiently locate dividend stocks using Schwab.com and the stock screener feature on that platform. So, should be a good discussion. We're going to be filling in a gap in our example paper money portfolio. We're going to be following up on its performance. A lot to cover before we get to any of that, though. Let me first of all say hello to everybody who's already chatting in out there in YouTube land. Hello there, Dom and Paul, Texas Beach Bum, Robert, Life in the Fast Lane, Richard, Eva, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the first time, I do want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but I'd like to issue an invitation to you if you'd like to join us in the live stream. This is a Thursday webcast series, and we kick things off promptly at noon Eastern Standard Time. Now, I also want to let you know that my very good friend Brent Moores is hanging out here in the live stream chat. He's going to be keeping an eye on any questions that I can't get to just during the flow of the presentation. Brent and I have been working together now for more than 2 decades. So I appreciate having him there at my back. Also, Brent and I would like to issue an invitation to everybody listening, whether on the archive or just here in the live audience, to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn. So you can find Brent on X at Brent Moores CS. You can find me there on X at Cameron May CS, or you can pop over to LinkedIn. Just go to linkedin.com/in/Cameron May CS. Give me a follow there. And social media is a way to connect with me in between the live stream. So let's get into this discussion, though. We're talking about dividend stock investing. We're talking about specifically today finding dividend stocks as that may be qualified as the investor sees fit. But before we can do that, of course, we need to consider the risks associated with trading or investing. So bear this important information in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Investing involves risks, including loss of principal. Diversification does not ensure a profit and does not protect against losses in declining markets. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. Very first thing that we're going to do is have a quick look at the markets. We're going to see how dividend stocks in general are doing against fixed income securities, because there may be some competition there between those two income asset classes. So we'll see how they're doing. And then we're going to have a look at our example paper money portfolio, see if we can identify any gaps in our diversification model. Then we're going to attempt to fill that gap using the tools available on Schwab.com. And specifically, we're going to be using the stock screener to build an example dividend stock screen. Going to try to quickly find a stock that meets our example portfolio priorities. And we're going to be adding to our positions with an example investment today. All right. So let's get right to it. Let's go have a look at what's going on with the markets. So we're going to start things off as we typically do with what's going on with fixed income. This series is not about fixed income investing, it's about dividend stocks. But even among dividend stock investors, they may keep a wary eye on what's happening with fixed income, because if bond yields are very high, very competitive relative to dividends on dividend stocks, it may attract away some investor interest toward a different asset category altogether, and it might put a downward influence on dividend stock prices. And this is actually what's been kind of happening over the last several months. Yields have been working their way higher. So again, if you're not familiar with TNX:CGI, this is the 10-year yield. Right now it's about 4.57%. That's how we would read this up here in the upper left. But yields recently were down below 4%. And they've been stair-stepping their way higher, and that's really pushed up right into this week. We've been coming down just a little bit, but bond investors who are fresh to the markets may be finding higher yields than they were finding, let's say, maybe 4 to 8 months ago. So that can attract some attention away from dividend stocks. However, dividend stocks have still been having a pretty solid run. Yields on bonds are not the only influence on the pricing of dividend stocks. They can be an influence, but there can still be independent demand for those stocks. So let's see what's going on with an index of dividend stocks. So the index that we follow from week to week in this webcast series it has the kind of long, awkward symbol, SPHYDMUT, SPHYDMUT, preceded with a dollar sign. There's your symbol. I'm going to hit enter, and what you'll notice here is the name of this is the S&P 500 Dividend Monarchs Index. These are companies that have increased their dividends every year for the last 50 years, who are also part of the S&P 1500. And this is a total return index. The TR stands for total return. So our chart reflects changes in price in the stocks in the index, but also all dividends collected. So if we net that all together, it has been a pretty good last 12 months with, yes, some fluctuation. That's the market risk influence on our dividend stocks category. Boy, dividend stocks having a really strong day today, though. Look at that. Really rallying higher with yields coming down a little bit. That might explain some of this move, but as I mentioned, there can just be demand for dividend stocks independently of yields, and maybe that's some of what's going on here. But overall, dividend stocks doing fairly well, and we're seeing that reflected in our example portfolio. If we pop over to our monitor tab now, we have 16 stocks in our portfolio that we've been building up over the course of 2026. And even though we've invested some back in January, some through the months in between, and we've recently still been picking up stocks as recently as last week, overall, we're up about 10% on this portfolio, plus theoretically, about 1.5% collected in dividends. I'd say it's probably closer to 1%. So net, if we're looking at total returns, unrealized gains on this portfolio, about 11% for 2026. And that's at a lower volatility, as measured by our beta here. So overall, doing fairly well, but here are the priorities for this portfolio. Now, these are just example priorities. They're not intended to be an exclusive or an exhaustive list of priorities. It's not supposed to be the list of priorities for a would-be dividend investor. But first of all, we do emphasize diversification. Diversification might help with risk in a down market, but dividend stocks can go down just like growth stocks, just like value stocks. But we've been spreading out a $200,000 example portfolio across a spectrum of sectors. There are 11 sectors comprising the S&P 500. Right now, we have 2 stocks in 8 of those sectors, totaling up to 16 stocks. So we have 3 sectors left. We have consumer discretionary, we have no position in right now. We have information technology, we have no position there, and communications. Now, that's kind of been a product, not a really deliberate selection process that's led us to leaving those 3 out. It's pretty much just that those 3 are among those that don't typically pay high dividends. But today I want to conduct a search to see if we can find higher than average yields in those sectors. So we're going to weed out the other 8, make sure we don't over-concentrate the portfolio in one of those 8, just look at our remaining 3. So that's going to be an emphasis today, is looking in those 3 sectors. Here we can see when the dividends are either upcoming as an ex-dividend date or when they've recently gone ex-dividend. We can see the dividend frequency. We only have 1 stock that pays monthly, the rest pay quarterly. There's our average yield. I think our average yield as of this morning's calculation was 3.29%. That's roughly 3 times the average yield of the average dividend paying company in the S&P 500. Our beta is our measure of volatility on our stocks. And we typically look for volatility scores below 1, which would imply below average as compared against the S&P 500. And every single one of our stocks has a beta score below 1. We also look for the debt load of the companies we're investing in, because as dividend paying companies accrue debt, that can introduce risk Now, not every time does it introduce risk, and not doesn't always lead to a dividend cut, but it might. If we have a company with a, let's just say that debt burden has grown to be so large that they have to redirect all of their cash flow into the payment of the debt. Where do they get that extra cash flow from? They might be pulling it away from shareholders from the dividends they've been paying, cut the dividends so they can service their debt. So we're going to make sure that as we're screening for new candidates today, that debt is in that screen function. Overall, though, profitable on the portfolio. We have a few positions that are slightly underwater. Looks like our worst performer right now is NEE, down about 4%. We have two others that are down fractionally. The rest are all doing well. If some of these grow much larger, we might need to trim those back. We've been monitoring these. Like, for example, Target is up 30%. And if a company grows to be too large of a portion of our portfolio, we might trim that back so it's not having a disproportionate influence on the portfolio performance. And our threshold here is we're going to allow these to grow up to 60% before we trim it back. Let me see, we're having some chats in. Eva is asking a question, or here's a suggestion for you, Eva. I don't mind a quick sidebar. She's asking if a couple of securities are real estate investment trusts. One quick way to check those things is to go to your Analyze tab and bring it up on the fundamentals page and check to see which industry it's in. And it would also usually be just mentioned right in the description. Let me type this in here. Like American Tower, yes, there it is. American Tower Real Estate Investment Trust. Okay. Oh, I see what you're saying, Eva. So we already have some positions in that real estate. So let's find those here. So there's Kimco, there's O, but there can be, yeah, some blurring of the lines. So Eva's point here, I think, is that maybe we find something in the communications sector that seems to introduce diversification into our portfolio, but maybe that sector is actually real estate investment trusts that are invested in, let's say, towers. I think that was the point here. If we go back here to our, pardon me, my Analyze tab, let's pop back to the fundamentals. And as we read this, American Tower Corporation is one of the largest global real estate investment trusts. It's a leading independent owner, operator, and developer of multi-tenant communications real estate. So can there be a little blurring of the lines between different sectors? There certainly can be. So this is one place we could investigate that. And if we're try to get, I don't know, if we want to call that a purer diversification, we can read through the company profile there and see if, yeah, if there's this, I kind of think of it as like a Venn diagram. That's when we draw two circles and there's an overlap in the middle. Yep. So that can be a useful tool. I won't be going that far, but that's a quick way that we might check that. Anyway, so we've done our portfolio review. We had a look at what's going on with the markets. We've done our portfolio review. We've identified what appears to be potential gap in the portfolio. So what we're going to do is try to fill that gap, and we're going to go create a screen, as I mentioned. But this time, instead of creating a scan on Thinkorswim Desktop, which we've done in the past, we're going to do a screen over on Schwab.com. But as we do that, I do want to remind us, if this is your first time watching our dividend webcast series, let me open this up. You're going to see some drawings from, or some text from yesterday's webcast. We don't need that anymore. Instead, these are our example priorities. Emphasis on example, because I'm not making a recommendation. Everybody's priorities ought to be the same for their dividend investing purposes. But number one, yes, we emphasize yield. Number two, and I want to make sure that I get these in the same order. So I'm going to cheat. I'm going to look over here at my at my notes. There we go. But yield diversification might be a point of emphasis for the investor. The consistency of the dividends being paid, because if dividends are paid sometimes but not others, our income investor might not be satisfied that, nor might be shareholders at large or writ large. We can see volatility in the stock behavior if dividends are inconsistent. Not always, but it could be. We've talked about the potentially important role that debt might play in the ongoing payment of dividends. Volatility of the stock for some investors is very important, because if they just want the dividends, maybe their preference is to minimize that volatility as they're waiting from one quarter to the next or from one month to the next for the next dividend payment. Maybe they don't want to be on a roller coaster ride in stock price. So we have emphasized volatility in this webcast series. And I will say, finally, total return performance. That's what is price doing and what dividends are being paid. Because if we're making 3% on dividends annually, but every year the stock is going down 5% in value, that's just not net accomplishing anything. But finally, yes, there are some who emphasize the payment schedule. We don't in this webcast series, but for some, they look at when are the dividends paid. Maybe their preference is to spread those out evenly over the course of the year, if possible. We don't worry too much about that. We'll just leave that up to the budgeting practices of our would-be investor here. But these first six are our real, let me just unbold that one to emphasize these first six are our example priorities here. So let's go find a stock that we don't already own, that's in a sector in which we don't already have some investment. How do we find all of these things, but using the stock screener on Schwab.com? Well, let's go do that. Let me pop over here to Schwab.com. So here's just an example fake account. And I'm going to go to the research tab. If you've never done a screen for stocks on Schwab.com before, we just go to research, we go to stocks. I think that's fairly straightforward. And then right here in the upper left is the stock screener. Long Snapper is saying, hey, Cameron, bump up the max yield to at least 7 to see what's out there, please. I suppose we could do that today. Open up the top end of yield, because traditionally what I've done, just to go to Long Snapper's point here, and it's getting a little bit ahead of me, but it's the first thing that we're going to be putting in our, well, it's not the first thing, actually. I'm going to do these in the order in which they appear on the screener. But I've typically capped our example yield search at 6%. Why 6%? Well, it's kind of arbitrary and kind of not. For dividend investors, I think it's fairly obvious why they might not be looking for stocks that have very low dividends. So maybe they might make a requirement to, let's say, average is about 1.1% out there. Maybe they're looking for above average. They might look for stocks that are paying, let's say, at least 2% dividends. So I think that just makes sense. But I frequently get the question, why do we put a cap on dividends? And I've put it at 6% historically in this series. But whether it's 6 or 7 or 8, why do we put on a cap at all? Well, it's because for some dividend investors, they see very high dividend yields as a potential threat. I know that sounds counterintuitive. Aren't we in this for the dividends? Well, yeah, we might be. But if a company is paying a very large dividend, that can be difficult to sustain. That money has got to come from somewhere. So where's it going to come from? It's got to come from income from operations, cash flow generated by operations of the company, or maybe drawing down cash reserves that the company's already stockpiled. Well, that can last for a little while. For some, who knows how much cash they have. But if they don't have the cash flow and they don't have the cash reserves and they really want to keep paying the dividends, then they got to start dipping into debt, piling up debt. And just like in your household, there's only so much debt burden we can sustain before the whole house of cards comes crashing down. So high dividend yields can sometimes be seen as a nice little feature right now, but possible red flag for the company's ongoing ability to pay those high yields. But anyway, the request here has just been to nudge it up from 6% to 7%. So I'll do that. Wasn't planning on doing that today, but we'll see. But let's build up our stocks. Let's start to build a stock screener. And if you've never used this before, to me, it's fairly intuitive. So what we're going to be doing here is selecting from criteria or categories over here, and then putting in specific metrics over to the right. So I'm just going to start up here. It's not going to go in exactly the same order as our listed 6 priorities, because I didn't build those 6 priorities to match perfectly, in step with the way that this platform is constructed. So the first thing we're going to do as we're addressing those priorities, let's click on basic. So we're going to go from basic, we're going to go down here to dividends, then we're going to do some price performance stuff, and finally some financial strength. All right. But overall, we're going to be choosing actually 10 example filters here. So starting with basic, first 2 are going to be market cap and sectors. Let's say that our dividend investor is interested in the company's ability to continue paying dividends. Small companies that are trying to grow may have other priorities other than giving a bunch of cash to their shareholders. And their revenue, their cash flow may be more inconsistent than maybe a larger, more stable company. Not every company that's large is stable, and not every small company isn't. But let's just say that our investor, maybe they're not looking for the micro cap or the small cap stocks. Maybe they want to see companies that are at least in the billions of dollars. So I'm going to select mid cap to large cap. And you'll notice there are over 10,000 publicly traded companies out there. There are about 1,200 that are mid cap to large cap. We're talking about multi-billion-dollar companies. Next up, a lot of those companies are in sectors in which we already own a lot of stocks in our portfolio. So there are only 3 sectors in which we don't already have some representation. So what were they? Just to recap, we don't own any stocks that are consumer discretionary. We don't own any technology stocks, nor do we have any communications stocks. So how do we add those? So let's come down here and let's check consumer discretionary. And you'll notice there are 112 mid-cap and large-cap consumer discretionary stocks. Let's add to that our communication services. Check that box. Looks like that's adding another, 62 communication services. So 174 companies meeting all of our criteria so far. And finally, information technology about doubles it. But we've narrowed down our search pretty substantially from thousands of potential companies to just 344 of the big ones in these 3 sectors. All right. So that is kind of the power of that basic screen function. Next up, let's get to the point of this whole exercise, dividends. Now, there are current dividends, and then there's the ability to continue paying dividends. So here's what we're going to do. Let's come down here, and we're going to look at the annual dividend yield. And let's say that our investor is looking for, let me scroll down a little. It's going to require a little bit of bouncing around, with my apologies. These sectors up here take up some visual space. But as I scroll down here, here's that annual dividend yield. We can look for yields that are less than 2%. We can look for yields that are between 2 and, who knows, maybe up to 6%, or we can look for something else. Now, the request came in, can we look for up to 7%? So I'm going to put in a specific value. That's not one of our default button values here. So I'm going to enter a specific value of dividend yields. Let's leave our minimum at 2%. That's what we've been looking for historically. And how about we crank that up to 7%? So out of the 344 companies in those 3 sectors that are mid-cap, large cap, there are 72 that are paying dividends between 2 and 7%. Now, there are possibly some of those that maybe they were previously paying 4% and then they've slid down to 3, or they've cut the dividend. Let's look for companies that are increasing dividends. So how about we look for increasing dividends year over year? And we also want to see positive growth rates over a 3-year period, a 5-year period, and a 10-year period. So we're looking for long-term consistency in dividends. So let's come down here. Here are the ones that we just added. Do we want to see dividends increasing or decreasing? Well, we want to increase. 3-year dividend growth rate, under 0, that would be negative growth rate. Let's just make sure that it's at least positive. 0 to 5, 5 to 15, 15 to 25, 25 to 50, or above 50%. Now, another way that I could have done that, let me just clear this. Quicker way to do exactly that same thing rather than having to click on all 5 of these buttons is just select them all and then uncheck under 0%. And then I can just do the same thing for the 5-year and the 10-year. Let's select them all, and then uncheck less than 0. So specifically now we're looking for companies in these 3 sectors that are mid to large cap that have an annual dividend between 2 and 7%, that they're increasing year over year, and we're seeing positive increasing of that dividend over up to 10 years. All right, now we've gotten through kind of the bulk of this screen. We've already added 7 different criteria, 2 in basic, 5 in dividends. There are 3 more though that I wanted to add because so far in our example priority list, if we come back here and we look at that, we've looked at yield, we've looked for diversification in the different sectors, we've emphasized consistency, but what's left? Debt load, volatility of the stock, and performance of price plus dividends. So let's see if we can address those using this screen, this stock screener. So I'm going to come down here to our price performance. Hey, that's what we were looking for, net returns or performance overall. Let's click on performance. And we're going to scroll down here to total return. Let's look at a total return, that is dividends plus price appreciation over the last 5 years, starting to edge out into that long-term horizon that maybe a lot of investors pay most attention to rather than the short-term stuff. So we're going to look at total return over 5 years. And let's say we want that to be better than 10%. Let's say 10%, 25%, or even up to greater than 50%. And then we're also going to include a beta requirement. Beta is, we talked about it briefly, but it's our measure of volatility. So some dividend investors, they're not interested in this roller coaster ride, a stock that's going up and down and up and down as they're just trying to wait for the next dividend payment. So maybe they're looking for lower volatility stocks. Maybe a little bit above average is okay, but not wildly above average. So let's put in our beta value. Let's enter specific values between 0.5 and 1.5. And the way to think about that is if we're benchmarking each stock against the S&P 500, a beta score of 0.5 would imply that our stock is about 50% as volatile as the S&P 500. 1.5 would mean that it's about 50% more volatile than the S&P 500. So kind of in a range, not completely dead flat or going the opposite direction of the S&P, but also not jumping all over the place from dividend payment to dividend payment. So there's one left. Let's come down to financial strength, and that's debt. So let's look at a gauge of debt to equity. If a company's equity is all being derived from increasing loads of debt, again, they may service that debt. They may choose to service the debt over paying shareholders dividends. So what if we just come down here to our debt to equity? And yes, we'll include companies with no debt. Or how about companies with a debt to equity ratio not exceeding 1, so less than 1? And after putting in all of these requirements, that's a lot. That's probably the most detailed screen I've put together in a long time. 10 different requirements. There are thousands of stocks that may be able to meet these requirements. There are actually only 4 that do meet all 10 of these. So let's click View Matches. And let's see what we get. Right here, we have 4 companies. We have ALV, DRI, we have NTES, and PAG. And one thing that I want to point out here is now that we've gone to the trouble to build this somewhat involved stock screener, it may be worth the time to come right up here and click on Save Screen so we don't have to rebuild this next time. So I'm just going to call this one very simply Dividends. Okay, save that. So if I were to shut down my platform, if I were to log off the website and come back, let's say, let's do this. Let's just go away, go to the account summary, pop back over to research and stocks, go to the stock screener. And if I look down here, there's the dividends screen, or we can access it right here, dividends. In any case, if I click on that screen, I don't have to put in all those criteria again. It just takes me right to the companies that meet the criteria. We can still see the criteria right up here. Shows us our screener. We know that market capitalization was mid cap and large cap, and so on. There's the rest of that. Long Snapper says, what criteria forced out VZ? I don't know, and it would take me, unfortunately, too much time to investigate. I'd have to look at all 10 of these things because it could be any one of them where it fell a little bit short. I don't know. So my apologies. Wish I knew off the top of my head, but I don't. Anyway, but let's have a look at, we can look at a few of these. But how about we look at, I've taken a glance at Darden. It has a yield of 3.3%, ALV 2.8%. But as we look at these, just be aware that there's a scroll bar right down here that allows me to see the different criteria that we've selected. Now, I already know these meet all of our criteria. So for example, they're all above 2%. I do notice as well that none of them are up in that 6 or 7% range. That's because those with those high yields, maybe they're doing it with too strong of a debt load. Maybe they haven't been increasing things consistently. But in any case, let's look at what's going on with DRI. And should we just compare it to maybe ALV? Let's do that. So at this point, I am going to pop back over to my Thinkorswim platform. And let's bring up, first of all, DLI. What was it? No, it was Darden, wasn't it? Was it DRI? That's what it was. So let's look at this over the longer term. Right now, we're seeing a 1-year daily chart, which might be interesting to traders or maybe some investors. But in this webcast series, what we look for is long-term performance of the stock, including dividends being paid. So to see that, I'm going to switch this to a 10-year weekly chart. And you can see, actually, this stock's had a pretty good run. Starting back here 10 years ago, this was a $60 stock, and now it's a $200 stock. So it's up, what is that, about 350%, something like that. But that's just what price has done. All along the way, this has also been paying dividends. And we can also, if we want to, we can glance at these dividends. So for example, if I zoom in, that'll kind of spread these out so I can see them a little bit closer. We can see the dividend back here a couple of years ago was $1.31, then it was increased to $1.40, and then $1.50, and just recently $1.62. So this is a company that's increasing its dividends. That was why we included this in a filter in that screen to try to find these sorts of companies. But the other thing I want to do, let me draw on a trend line as a reference point. So that's where we were 10 years ago. This is where we are right now, but this is just a price chart. It doesn't include all of these dividends that have been collected. And you can see if you're collecting $1.50 4 times a year or $1.30 4 times a year, that's going to add to this net performance pretty substantially. So let's build in that. And to do that, we can come up to our edit studies, not our edit studies, my apologies, the chart settings, the little gear icon. We're going to go to the equities tab because we're talking about stocks. And I'm going to change this chart to adjust for dividends to show all of those dividends. So as I click apply and click OK, you can see our trend line has moved because the angle of the ascent of the total return line has shifted. This is now reflecting all the dividends that have been paid. And the difference there is about, I'm just eyeballing, it's about $40 worth of dividends that have been collected by a shareholder, a long-term shareholder over those last 10 years. Makes sense. If you're collecting basically a dollar per quarter, $4 a year, that's about 40 bucks. So there's one of the stocks that the screener has found. Now, just because this has been doing well, total return over the last 10 years doesn't mean it's going to continue necessarily, but it is otherwise qualified from our screen results, and it's a candidate for our example portfolio. But let's compare this to the other one. What was our other one? ALV is paying 2.83%. Let's see what it's done over the last 10 years. There we go. This one's still up. It had a rough go for about 2 years right here. So really most of this growth has been since right about here. Now it doesn't look like, if we were to look over a 10-year time frame, here's the growth including price plus dividends, not a ton. But over the last 6 years, this has gone from about a backward dated value of about 23 bucks to $124. That's about a 500% return. All right. But this is just for that investor who might be looking to make sure that the price isn't overwhelming the dividends. Stock that's going down at the same time dividends are being collected can lead to a net performance that's actually negative over a long stretch. But which one do you think we should invest in? What do you think? I'm going to throw this out as a quick reminder. Here's DRI. There's Darden. And then I got to remind myself, what was the other symbol? Let's go to, I don't know if you knew you could do this. You can click on the little down arrow right here and then choose recent, and we can find our other symbols here. But how about, I'm just going to cheat. Go back here, look at our search results. ALV, that's what it was. ALV and DRI. I'd say it's losing my memory. I'm not that old. I'm 54. So Sharon, you're voting, looks like Sharon is voting for DRI. We got Paul voting for DRI. Typically what I do here is I'll throw this out for a vote, and the first symbol to attract 3 votes is the one that we invest in. So how about you chat in DRI or ALV, and let's add to our example portfolio. So I do have a vote here for ALV. There's that DRI again. All right, there's a vote, the tiebreaker, not the tiebreaker, it wasn't a tie anyway, but let's say the deal sealer just came in. DRI got its 3rd vote. So let's go to our trade tab and let's buy some shares of DRI. Now, here's the way we're going to make that investment. I'm going to come up here to the ask price, and this is interesting. It's right almost exactly 200 bucks. This isn't going to be very difficult math. If we have $10,000 in our $200,000 portfolio, that's 5% of our portfolio that we invest in each stock. We could do the math on this, but I did want to show you one little technique I haven't done before. Let me click on the ask price here, and I'm going to put in an order to buy. Now we could do, 10,000 bucks divided by $200, or I thought maybe some of our investors watching don't know that this is available on Thinkorswim. I'm going to click on this little where it says value in units, and right now it's showing shares. If I click on that, I can also choose dollars. So how about we look to invest $10,000? And what if I'm willing to spend up to, let's say, $200 per share? So I'm going to put in a limit order of 200 bucks per share, and this will just buy as many as it can for $10,000. Now it still has to meet the requirement of $200 as our limit. If the price is over 200 bucks, it's not going to make an investment. All right. But it also just won't exceed our $10,000 limit. I'm going to click confirm and send. And by the way, yes, I could put in a market order and just get as many shares as possible. Just be aware, if I put in a market order, we might wind up with fractional shares, depending on whether the stock is qualified for fractional shares or not. I'm just going to avoid fractional shares by putting in a limit order. Limit orders will not purchase fractional shares. So let's buy $10,000 worth of DRI. It looks like we should be able to get that. We're still under 200 bucks. That's not guaranteed. There's no commission on this order, but there can be on some types. Let me send this order off. Okay, so let's see if we can get it. And we did. We bought, notice that, 50 shares. That's what you can get it, 200 bucks a share. Got those 50 shares for $199.75, didn't exceed our $10,000 limit. And we're now invested in a new sector. So continuing to expand our diversification in our portfolio. We'll see how DRI does from this point. Let's see, is it? Yep, we'll just follow up on that in a future webcast. Sharon, you're welcome, but we've accomplished what I've set out to do today. Everybody, what I wanted to do today was introduce you to how to do a stock screen using the tool on Schwab.com. So we've built a custom screen. We saved that screen. We'll have quick reference to it if we want to use it again in the future. This is what we do with our Thursday discussions. So if you'd like to join us here, you're certainly invited to join us. This is, again, it's a Thursday webcast series. We kick things off promptly at noon each Thursday. Now, I have some other suggestions for you, though. First of all, if you're new to our webcasts, make sure that you subscribe to our YouTube channel, because that's where you can join our live streams, and you can also find the archives for previous webcasts. So our YouTube channel is called Trader Talks Schwab Coaching Webcasts. So find that on YouTube, or just pop down below the video stream right now, click on the subscribe button. It only takes a second. Doesn't cost anything to do that. You can join our live streams here, or you can find our playlist of previous webcasts right there, including the webcast for this webcast series. So if I wanted to find that, click on playlist and just look your way down. Each one of these has a label right here. So you just read each one of these and you'll notice, hey, there's Cameron's investing in dividend stocks. And so I can click on view full playlist, and there's last week's discussion. Here was Brent filling in, and so on, right? Now, another suggestion that Brent and I have for you today is to follow your favorite Schwab presenters on social media. You can find us on X. You can find and follow us on LinkedIn. You can find Brent there on X at Brent Moore CS. You can find me on X at Cameron May CS. Just published a little video here you might want to check out. But if you reply to my posts on social media, I just try to reply right back to you. It allows for interaction when the camera's not on. I get the question, Cameron, how do I reach out to you? The way to reach out to me is through social media. You know, I can't do emails. Sorry. You can't text me, but you can find me on social media. You can also find and follow me on LinkedIn. So just pop over to linkedin.com/in, and then /Cameron May CS is my handle there. Give me a follow here. And if you reply to my posts here, I try to reply right back to you there as well. All right. Brent, thanks for helping out, chats. That's very much appreciated. I can see over 100 people watching the live stream right now. And as I refresh my browser, 40 have clicked the thumbs up. Thanks for doing that. If you're watching a webcast and you enjoyed it, make sure you always click the thumbs up, whether it's live or it's on the recording. They both count, but it's a thumbs up for your presenter, but it also gives us a boost in the YouTube algorithm. It sends the message to YouTube that this was a good video. Show it to other people. YouTube takes the hint, right? Thanks, guys. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.